The global monetary system came within inches of implosion in March 1968, yet almost no one outside a narrow circle of central bankers noticed. What failed wasn't a bank, or a hedge fund, or a country's fiscal position. It was a secretive, cooperative intervention effort known as the London Gold Pool, an 8-nation agreement to suppress the market price of gold to defend the US dollar. Under Bretton Woods, the dollar was convertible into gold at $35 per ounce. But, by the early 1960s, foreign governments and private investors had started to doubt the sustainability of that price. U.S. deficits were rising amid President John F. Kennedy's promise to run stimulative fiscal policy, gold reserves were shrinking and foreign dollar holdings were ballooning. The U.S. had lost nearly 46% of its gold reserves, dropping from 20,312 metric tons in 1957 to around 10,892 by the end of 1968, as foreign central banks increasingly redeemed dollars for gold, further straining the system. So, the US, joined by West Germany, the UK, France, Italy, Belgium, the Netherlands and Switzerland, began pooling physical gold to sell into the London market whenever the price ticked above $35.20. The goal was to prevent a run on the dollar by making the gold market boring. This required a delicate balance, as the pool had to absorb speculative demand without depleting reserves too rapidly, all while maintaining the illusion of dollar stability amidst growing global economic imbalances. It was a deeply unnatural market. The pool was selling real, official sector gold into the market to absorb speculative pressure, while the US continued running deficits and inflating global dollar balances. The longer it lasted, the more untenable the arrangement became. As such, the artificial suppression of gold prices distorted market signals, encouraging speculators to bet against the fixed price, while the US's persistent deficits, fueled by Vietnam War spending and domestic programs like the Great Society, only deepened the structural flaws of the system. Worse, France under President Charles de Gaulle openly defected, calling the system a rigged dollar hegemony and withdrawing French gold from New York. In 1965, de Gaulle started exchanging French dollar holdings for gold, publicly criticizing the US's exorbitant privilege as the world's reserve currency issuer. This move not only reduced US reserves further but also prompted other nations to question the system, with France's actions seen as a direct challenge to US monetary dominance. As part of this policy, France repatriated a total of 3,313 tons of gold from the US and UK between 1963 and 1966, including a publicly announced conversion of $300 million, equivalent to 267 tons, in January 1965. Private demand rose. Central banks doubted each other. The devaluation of the British pound by 14% on November 18, 1967, added further strain, as sterling's role as a secondary reserve currency meant its collapse rippled through global markets, intensifying speculative attacks on gold. This link between sterling and the market price of gold was not a sudden phenomenon arising in 1967 but a key feature of the international monetary system since at least the troubles of sterling in the fall of 1964, the National Bureau of Economic Research said in a 2016 working paper. Our contention is that contagion between reserve currencies, rather than non-cooperative behavior, explains the failure of the pool. And, by March 1968, speculative demand for gold had become so strong that the pool bled nearly 1,000 tons of gold in a single week. On March 8 alone, 100 tons were sold, compared to a typical daily sale of 5 tons, highlighting the unprecedented pressure. From there, the crisis peaked as markets sensed the pool's reserves were nearing exhaustion, with the US and its allies unable to sustain the defense of the $35 price. The US Treasury and the Bank of England jointly decided to shut the London gold market on March 15. This closure, supported by a British bank holiday declared by Queen Elizabeth II, was a desperate attempt to halt the hemorrhage and buy time to devise a new approach, as global markets teetered on the edge of panic. When the market reopened 2 weeks later, it operated on a two-tiered system. Central banks would still deal in gold at $35, but the free market was allowed to float. This compromise, finalized after tense negotiations in Washington, D.C. on March 16 to 17, effectively ended the pool's operations, as members could no longer sustain collective intervention. The free market price quickly rose above $35, exposing the fragility of the fixed rate and creating arbitrage opportunities that further undermined the system. This was the beginning of the end for Bretton Woods, even though Nixon wouldn't formally close the gold window until 1971. The entire system had hinged on a lie that $35 gold was sustainable. And the London gold pool had been the enforcement mechanism. Once it died, so did the illusion. There are echoes of the pool today in how policymakers intervene in bond markets, FX swap lines, and commodity markets. Modern interventions, like the Federal Reserve's quantitative easing or coordinated central bank swap lines during the Great Recession, reflect similar attempts to stabilize markets by overriding supply and demand, often at the cost of long-term distortions. The mechanisms evolve, but the instincts don't. When credibility is the currency, the gold is always on loan. The lesson of the pool endures: no amount of coordinated intervention can indefinitely suppress market realities, as credibility, once lost, is hard to regain, leaving central banks to navigate an ever-shifting balance between control and collapse.